Okay, Assalamu alaikum, everybody. I hope all of you are doing great, Alhamdulillah. My name is CHERIF Abbas, CEO of Islamic Finance, Intelligence and Management, IFIM, in Ivory Coast. I would like to start by thanking all of you for attending this webinar. The main subject of this webinar is the role of Islamic finance in financing agricultural sector in Africa. For addressing this question, I have we have some partner, and we will start firstly by Brother Omar Mustafa Ansari, Secretary General of AAOIFI. Also, we have Dr. Houssem Eddine Bedoui and Dr. HASSAN Syed ALSAGOFF from Islamic Development Bank, and we also have SYED Ben Afane Ibouroi from ITFC. So I will just share maybe some indication about how to use this platform. Okay, the webinar will last for 2 hours, including Q&A session, during which the main speaker will address your questions. If you have any questions, please just send them using the Q&A box, and we will just try to send them to the panelist, inshallah. I think we will start by Brother Omar Mustafa Ansari, who have to share some information or a slide presentation about AAOIFI, all AAOIFI experience and work in the field of Islamic finance, in the field of agriculture, inshallah. Assalamu alaikum, Brother Mustafa.
Wa alaikum assalam wa rahmatullahi wa barakatuh, Brother Sharif Abbas, and assalamu alaikum everybody, brothers and sisters. It's a great pleasure to be with you. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. I hope that today's discussion will be fruitful for all of us for a great learning on a very important area, because whenever we talk about Islamic finance, we talk about the real sector, the real economy, and the real transactions. And we say that Islamic finance is still in its infancy stage, because the conventional finance has developed experience over hundreds of years, while the Islamic finance in the current form is around 4 to 5 decades old at max. And in most of the markets where it exists today, it is not less than 10 or 20 years old, and this time is not sufficient for a new industry to develop properly. And particularly considering that Islamic finance started working in the paradigm of the conventional finance, so it is still trying to find ways and paths how to link the real economy with the financial sector. Some of the success stories are there from different countries at a small level or large level, and some are, we could say, that they are more or less, I would say that they are more or less, experiments which are very weak and vague. Brother Sharif Abbas, can you allow me to share my screen? It will be easier because the version you have is PDF and the version I have is PowerPoint. So that may be like better if you allow me to share the screen, brother.
Yeah, I think you can share your screen so that people will see.
Yeah, host has disabled attendee screen sharing. So if you allow me to share the screen, it will be much better.
I think
you just need to allow me if you are the host, whoever the host is from the IT side. Okay, now it is allowed. Thank you very much, brother.
Yeah.
Yeah, because this way the screen will be better shared. That's my idea. Thank you very much, brother. So now we continue our discussion. So the topic of agriculture finance is very vast topic, and there are so many angles to it. So we had to be limited. The initial subject that was assigned to us was with regard to 2 of our standards, that are standard on Salam and standard on Musaqat, and they are very important standards for the agriculture finance. But then I added a few more areas to that, One of them, which is very important, is the barriers as to why normal Islamic financial institutions are unable to contribute to the agriculture sector, because this is still a weak area of Islamic finance. So what are those barriers? And then there is a scheme proposed, which is related to making this more feasible by ensuring an agriculture credit takaful scheme. With regard to the scheme, we will not be having enough time. So I will request Brother Sharif Abbas to share my presentation, but I'll try to cover the main two products, and I'll try to cover additionally the main barriers which are there for agriculture finance. I don't want to go into numbers. A few numbers are there, but particularly, I would say that Africa is one of the continents that is significantly dependent on the agriculture income. And maybe as a percentage of total GDP, you will not find it a huge number. But like a lot of countries in Asia and major part of Africa, and particularly the Muslim countries in the African Northern African region, and in the West, and also on the east side towards Sudan, etc., you will find a lot of people who are directly or indirectly dependent on the agriculture sector for their base living. Even if the total, we can say the total GDP percentage created by agriculture might not be that huge. And that might be one of the reasons that the financial sector keeps agriculture at a low priority, because the financial sector sees where the major income is coming, and agriculture sector is feeding more people, and it is giving employment to more people, but is generating less amounts of revenues. So the result is that it does not become a prime priority normally for the financial sector. And this applies to Islamic finance as well. I do not want to go for further details in this area about numbers, etc. And I believe that our other fellow panelists will also be covering that. I'll just, for those for whom Islamic finance is new, I could see a few names of our brothers and sisters who are well versed in Islamic finance in the participant, but some of you might be new. So let me quickly go through about the products very quickly. Islamic finance replaces the conventional interest-based products with Sharia compliant products. That's the whole idea. So riba is prohibited, but Allah subhanahu wa ta'ala said that وَحَلَّ الْبَيْعَ وَحَرَّمَ الرِّبَا. So it means that Allah subhanahu wa ta'ala prohibited riba, but allowed lot of opportunities related to trade. And this include different forms of trade and other similar activities. So most common products of Islamic finance include sale and trade based contracts. These can be in two types. One is where you have a deferred payment, and one where you have a deferred delivery. In the deferred payment, most common product is murabaha. You also have musawama. People also have tawarruk also. It's not a preferred form of Islamic finance, but tawarruk is also there. Then we have deferred delivery based transactions, which include salam, istasna. I will not go for detail and explanation of all of these. The second main category of Islamic finance products is lease based contracts, which include ijara muntahiya bit tamliq, and you have diminishing musharaka type products, which are just a type of ijara muntahiya bit tamliq. Then you have the products which are based on participation and equity. Most common are musharaka and mudarba, but then there are three types of agriculture partnerships, including musaqa or musaqat, muzara, and mughas. All these products, when we talk about, they have 2-3 core principles. Number one, the risk and reward sharing. Means that all the Islamic finance product have a precondition that you must take the risk of the product or the asset or the transaction or the venture if you want to make money. You cannot just make money by investing money and not taking the real sector risk. And that is the point where I started in the beginning of my presentation, that Islamic finance is all about linkage of financial sector with the real economy. And all these transactions, whether they are participation-based or sale-based or lease-based, they create a direct link of the financial sector with the real economy. And actually, you need to support the real economy by feeding it with the money and capital which is needed in these different, through these different products. In agriculture, more common products are salam, muzara, musaqat, mugharsa. But additionally, you can have murabha and other products which can be used for the purpose of transactions on Islamic agriculture finance. Like for example, if you need seed, or if you need fertilizer, or if you need pesticides, these can be provided based on murabha. Similarly, if you need a tractor or thresher or other equipment, it can be provided based on ijara. So other forms of Islamic finance can also be used for the agriculture finance in their different needs. Because again, in Islamic finance, you don't just lend money. You identify the need of the business and then you provide that need through resources. Those resources can be assets, goods, commodities, human resources, services, entrepreneurship, and whatnot. So many different opportunities are there. But for today, we will touch upon mainly salam and musaqat, and we'll try to learn about the main product, the main Sharia terms and condition for the product, and a little bit about how the product is used or can be used in Islamic agriculture finance. I personally believe that it's better to take questions at different stages, but I think the program format is that questions are left for towards the end, and I'm given a very limited fixed time of half an hour. So I need to try to squeeze my presentation within that time. So we will be taking questions later, but I believe there must be some questions coming into your mind. Now coming to salam, the first product, salam refers to advance payment for goods which are to be delivered later. Means that it is a forward sale contract or a deferred delivery contract. In Sharia, generally a forward sale transaction or a future sale transaction is not allowed. The only two exceptions which are allowed are salam and istasna. Why future sale is not allowed? Because number one, it creates significant gharar and jahl, means it creates significant uncertainties and ignorance. So the transaction is not considered to be valid. Second main issue is that future sale transaction delinks the real transactions with the financial market. Like for example, internationally, if you see the derivatives market, which is working on the future transactions, is actually many folds the time of the original transaction. It happens in commodities, it happens in oil, and that is one of the reasons that the rich makes more money and the genuine farmer or the producer loses money. So this is a situation which Islam does not allow, and it does not happen today. It is since the beginning of the Islamic teachings that future sale is not allowed, but salam is allowed. Why? Because salam, number one, does not have that significant level of uncertainty, and secondly, it creates a direct link with the genuine transactions. So what is the most common use for salam? The most common use for salam is where you actually pay an advance to a farmer or other producer against produce which is measurable and quantifiable and specifiable from qualitative characteristics. So you make a payment in advance and agree on a delivery date. The product should be expected to be available in the market. So the person, even if he does not produce it itself, he can purchase it from the market and deliver it to you according to the contract. So this is one of the second one is istasna. We don't need to go for detail for that right now as we have limited time. But this is one of the type of transactions, and it is very much permissible directly from the Nass al-Shar'i, means that there are hadiths that refer to salam or salaf, which is the other word for salam transactions, whereby it clearly allows that it is permissible in Islam and it is not riba like certain other transactions, and it is permissible. With regard to salam transactions, there are certain conditions. I'll just touch upon some of them which are more important. The most important thing is that the seller has to get full advance. It is not a margin trade. So it has to be highlighted very clearly that what is the amount of payment and what are the specification of goods, and the amount of payment must be made in advance. So it is not like margin trade or like a derivative. It actually, from the accounting perspective or the regulatory perspective, it doesn't need the definition of a derivative because 100% advance payment is made. As I mentioned, the goods must be specified very clearly, identified very clearly, and I'll just touch upon some of the important conditions for that. Goods must be defined, quantity and quantity should be measurable. One of the important part is that it has to happen in the homogeneous goods, meaning that the goods in which every item is similar to the other item, like grains or like some type of fruit, etc., or some vegetable. And there is a long list of those things, but it cannot happen in those type of things in which every item is separately identifiable and has different characteristics. It cannot happen in the transactions which are in the goods which are already in existence. It cannot happen in the transaction in the items that are amwal rabwiya, means that those are currency, gold, silver, etc. This is to avoid interest in the garb of the name of the garb of salam. So the whole idea about it is that this is to facilitate the genuine producers so that they can get money in advance, and the purchaser can make sure that the price is locked and the delivery is available on the due date. So this is the biggest advantage of salam, that for the seller, the price is locked, he gets the amount in advance so that he can use that money. This is another important thing, that what money he gets against salam can be used for any purpose. It's not necessary to be used necessarily for the same produce. So it gives significant flexibility with regard to the financing options and the use of finances which are acquired through salam. Salam, as I mentioned, it has to be lump sum payment in full, but there can be tranches, and each tranche can be paid separately and can be delivered on a separate date if somebody wants installments. So this is one of the solutions. I don't want to go for further details. I have just touched upon most of the important things. But most important thing that I would like to touch upon here is that it is impermissible for the buyer for the goods on salam basis to sell these before actually receiving the same. Means that that sale before possession condition applies here as well. And this is one of the restrictions which are there, because this also ensures that this does not convert salam into like a derivative market thing where you can just buy and sell and net off. It's not like that. Rather, every transaction has to be a genuine transaction. Most important thing is, I would like to just touch upon how salam is actually used. Like, for example, if I'm the bank and I'm supporting by financing the producers of, for example, wheat. So let's take this example that there is a farmer who comes to me as a bank and I give him maybe $100,000 in advance. Now that $100,000 advance normally will be at a discounted price. Normally, for example, the produce that he will agree to deliver to me on the normal market rate, it would be generally more than 100,000. And this is the way how I actually make my profit. So I make my profit as a bank. I make my profit by selling the goods that I have actually received rather than by way of purchasing. Purchase is only the first leg of the transaction, and sale is the one where I make the profit. Now, how I will sell it? First option is that I can wait for the delivery and then sell it in the open market if I have the capacity. and I can earn profit. Some Islamic microfinance institutions have done this practice, and it is quite beneficial for them. One of the reason is, the biggest reason is most of the markets, you know, the farmer is not the one who gets the maximum profit. It is the one who is the broker and the wholesaler. They are the ones who actually make the maximum profit. So if you can channelize the resources properly, and if you can use these funds properly, then Islamic banks can also make good money out of it, because normally these middlemen make good money. So you can eliminate that middleman by doing this work and get that advantage. And we have seen it at, not at a huge level. We have seen some transactions in some parts of our world at a larger level as well. But in the micro sector, we have seen it more successful. The second option, which is more common with Islamic banks, is that to sell the commodity through an agent, and normally the customer becomes an agent here. So once the goods are delivered, we ask the customer to sell them into the market. Particularly in some countries, it is used for export finance, where the export orders are also available. So the bank feels fully secured on that. The third option is to create a parallel salam transaction on the same commodity. So what happens that we have a parallel salam option, which is independent of the first transaction. And this way we sell the transaction, we just get the margin between the two transactions. Another option is to obtain a promise to purchase from a willing party from the beginning. So in this situation, the party that is giving the promise is not in parallel salam. The party that is purchasing also need to pay me full amount in advance. But in case of promise from a willing party, and as this is also more common in case of exports, etc., then normally this does not need a full amount of payment or a full advance payment. So these are the more common forms in which Islamic finance, financial institution can sell the commodity and make their profit. And these different options are applied in different sectors. As we see, salam does not have a major portion on the Islamic financial institution balance sheet around the globe, but we believe that it has a great potential to support the economies of our Muslim countries, in particular from the agriculture side. As I mentioned, we can take questions and comments towards the end, because the time is allocated towards the end. Musaqat, we have our standard number 50 on this type of partnership. This is one of, there are three types of partnerships. Muzariyat is more common, then Musaqat is there, and the Mugharsat is the third one. Musaqat is a transaction or agreement between the owner of an orchard or trees or its usufruct and a working partner, agreeing to share the produce according to specific ratios stipulated at the time of the contract. The produce yield of such trees include fruits, flowers, leaves, and other produce, for example, chemicals, rubbers, gums, etc., as agreed. The basic difference between Muzariyat and Musaqat is that the Muzariyat is for the routine crops. It is generally for the crops, while Musaqat is for the trees and those plants which are there for more than a year and which give their yield over a period of time. I'll just touch upon some of the important Sharia conditions from our Sharia standard, the do's and don'ts of the Musaqat. The relevant trees should be identified. They must be productive and in need of irrigation and plant husbandry. The period of agreement must be known. The framework of duties must be defined very clearly. A worker is obligated to care for the trees and take care of the plant husbandry needs and all the things. He cannot commission or subcontract unless he gets approval from the owner. And he may hire employees and works in a fiduciary capacity. The owner shall facilitate the worker with full access and remove the impediments in his work. Expenses are borne in proportion of respective share of produce that is agreed, and worker is solely responsible for the work. If the worker stops work before the crop is ready, he's not entitled to any return. But if he leaves the work after the crop is ready, then a third party will be hired to complete, and his share will be deducted for that payment. If the owner does not enable the worker to work, then the worker shall be eligible for wages as per market norms, and all produce shall be shared unless we define it to a specific type of produce. How Musaqat can be used? Actually, options are there. The use of the Musaqat in the practical field is very limited as of now in Islamic finance, but it has a huge potential It has a huge potential for creating sukuk. It has a huge potential for particularly for for the barren lands in Muslim countries. There are huge barren lands which can be cultivated by musaqat, by having large contracts, and the Islamic finance sector can significantly support these sectors. I don't want to go into detail for the products, because there is one very important aspect, as I mentioned in the beginning, I would like to touch upon, and that is the barriers for Islamic agriculture finance. These are the two products that we discussed only. There are more, as I mentioned, that the Muzarat is there. There are other options. And as I mentioned, other common modes of Islamic finance are also available. Like, for example, the machinery can be supported through Ijara. The seed and the supplies and the fertilizer and the pesticide, they all can be supported by Murabaha and other products. So there are so many options available for Islamic finance. So the issue is, in my humble view, the issue is not that we don't have the products. The issue is that there are products, and there are so many products that for each type of need, you can find and identify some good products. So the issue is not that we don't have good products available for Islamic finance, but there are some more important factors that, as I mentioned, I would like to touch upon. First of them is undocumented sector of economy. The agriculture sector in almost all Muslim countries, and even non-Muslim countries, is considered to be generally a non-documented sector, undocumented sector of economy. And it is very difficult for a institution that works under very strict regulations, that it goes into a undocumented sector and takes significant risk. And this is a huge factor that actually impacts the decision making of Islamic financial institutions, and it does not enable them to go for Islamic agriculture finance. Banks and IFIs having lack of business understanding. You just go and talk to some of the friends in your Islamic banks, and you will come to know that they know nothing about agriculture. And this is a very common thing. With regard to some industries, they might be aware. With regard to some of the business practices, they would be aware. But when you talk to them about the agriculture thing, most probably majority of them will be completely unaware about it. And that is one of the important reasons that any person who does not have knowledge of the respective business, and obviously he is in a very risky business, very highly regulated business, it is very difficult for them to go for this, because they don't have the business understanding. They don't even have an idea as to how good profits can be made by Islamic financial institutions without impacting the farmer, only by, like as I mentioned earlier, only by removing the middleman from the supply chain. Unstable profitability, survival, and growth. This is one of the problems that, for example, locust is impacting these days significantly in a lot of Muslim countries in the region. So locust is one of the examples. There are floods, there is heavy rain, there is lack of rain, there is a lack of canal water and other options. So there are so many uncertainties, and at times survival and growth opportunities are significantly limited. So it is very difficult for the Islamic financial institutions to do a proper planning for those businesses. Owners and managers often lack commercial experience. Our brothers who are normally having the farms and having the agriculture business, I'm talking about generally speaking, I'm not saying all of them, but in our Muslim countries and our societies, you will find a lot of them, they are actually less educated as compared to those who are running the industries and those who are running the commercial businesses. So this is normally actually because of their lack of knowledge, they lack commercial experience as well, and they themselves are not very much familiar with the banking sector and the Islamic banking, etc. A lack of financing guarantee program. This is one of the biggest issues. Towards the end of the presentation, I have a scheme proposed. I believe we don't have enough time to discuss it. I would like to complete this slide at least before my time runs out. But the idea is that if you want to actually bring in Islamic finance into the agriculture sector, you must bring in a good credit takaful scheme in a way that the overall results are sustainable for the Islamic finance, the risk and the capital requirements are managed. So otherwise it will not be possible. No regular bookkeeping. Most of the farms and other agriculture producers, you will find that they don't have regular bookkeeping. Yes, obviously there are corporate farms, there are large institutions, there are some people who have a minimum level of bookkeeping, or some of them are maybe corporate entities who have a good level of bookkeeping, but they must be a very minority sector. The majority for sure does not have regular bookkeeping, so it is very difficult in absence of bookkeeping how you are going to evaluate their credit worthiness, etc. Owners reluctant to obtain interest-based financing. This is also one of the factors that most of the owners who are there in the Islamic agriculture sector, you will find a large number of them are reluctant to obtain interest-based financing. So they are not even used to banking. And if they are not used to banking, they are not used to Islamic banking as well. Basel 2 and 3 requirements, more capital needed. Basel, because of the Islamic financial institutions being subject to the Basel 2 and 3 requirements from their regulatory framework, it means that if they go for the agriculture finance, they need to put more capital. Now, if I have a government sukuk and I invest money in that, my capital requirement is nearly zero. But if I invest in agriculture sector, in a nutshell, I need to put maybe roughly 15% of the amount out of my own personal capital as the owner of the bank, which makes it it makes it difficult, but nearly impossible for people to manage. High risk of financing, obviously because of some of the factors that we discussed above, and particularly because of the volatility and stable profitability, survival and growth issues that we discussed earlier. The financing is generally considered at a high risk and people are not in favor of it. Lack of credit policy, even the third-party credit policies and the credit insurance is not available either conventionally or from the Islamic perspective. Now we are seeing some of the global donors coming into it, some regulators taking some action and bringing some schemes, but still that is not sufficient. And actually one thing which we need to add here is very important, that it's not only credit takaful. In most parts of the Muslim countries, you will find even the crop takaful is not there. Crop insurance is not there. So if you don't have the crop insurance, you are at a significant risk. So this is one thing that we need to consider. And then IFI's lack of capacity to evaluate agriculture credits, because evaluating the agriculture credit or evaluating the agriculture products and transactions is not exactly like evaluating an industrial concern or evaluating a commercial enterprise. You need to apply altogether different methodology, and you need to apply the business understanding. You need to apply the risk of volatility on all those things, and you need to put a risk management mechanism which is different from the conventional and which is different from our other service areas and our different sectors. So this is also one of the challenges. So I would like to complete my presentation here. I feel that I'm completing my time and I don't have time to touch upon the agriculture credit, the Kaful scheme that is proposed towards the end of the presentation. I request Brother Sharif Abbas that it can be shared with all the participants, and I'll be available for any questions and answers. Thank you for listening to me. I'll be available for any questions and answer later, inshallah. Thank you, Brother Abbas, again for inviting me. Thank you very much. Assalamu alaikum.
Wa alaikum salam wa rahmatullahi wa barakatuh. Thank you very much, brother, for presentation. I think it was a very interesting presentation. I know there is a lot of things to share and to say about agriculture, especially in our continent, Africa. Indeed, the AAOIFI standards have acclaimed wide popularity actually in the world, and in fact, they are deemed to the most outstanding Sharia reference for the industry and its stakeholders. We thank you for all your work and your efforts, and I would like now to invite Dr. Houssem Eddine and Dr. Syed HASSAN from Islamic Development Bank to share the insight on the prospect and challenge of financing agriculture through Islamic finance contracts from the ISDB in the world. Brother Said or Brother Houssem.
Yes, Assalamu alaikum wa rahmatullah. Thank you so much, Mr. Chairman. Thank you so much, Abbas, and thank you, IFIM, for the invitation. Just allow me to share my screen now.
Assalamu alaikum. My name is Dr. Ibrahim Ahmad Muhammad from Nigeria. Yes.
Just give us some minutes. Actually, it's Mr. Houssem talking.
Yes. Do you see my screen, Brother Abbas?
Yeah.
Perfect.
I'm seeing it. Okay, no problem.
Okay. So today my presentation, or the IDB presentation, will be done by myself, Houssem Bedoui from the Department of Strategy and Transformation, and my colleague, Brother Hassan from the Economic Empowerment Department. We'll start by presenting the big picture of value chain financing of the agriculture industry. And my colleague later on, Hassan, will continue with the case studies and real cases and examples from IDB experience. So let me start first by the IDB development model. IDB in 2017 adopted a new development model that focuses on 3 key priorities. The first one, IDB's new development model promotes a change of narrative for development by adopting a growth mindset focused on sustainable value creation driven by competitiveness of industries and enhancing the integration of global value chains, what we call GVCs. Second, moving member countries into more complex products driven by science, technology, and innovation, STI, which will give those countries first mover advantage, create high domestic value add, and thus lead to export growth and diversification. Third, the bank is aligning its funding model with the new and ambitious objectives, transforming it from a traditional development bank to a bank of developers, and thus become an open, decentralized platform for crowding in market resources, both financial and in kind. Moreover, the President's program crafts a new development model that aims to make markets work for the development in order to realize what we call the 1-5-10 opportunity. 1 stands for 1 trillion, and 5 stands for 5 industry, and 10 for 10 million jobs. So the global capital market and investment funds hold about 218 trillion thousand. It is IDB's belief that if only 1% of these funds could be pursued to invest in the core sectors of the SDGs, the Sustainable Development Goals, the existing financial gap could be closed, not only in IDB member countries, the 57 member countries, but globally. So by committing to structural reforms, IDB member countries can catalyze 1 trillion of financing into the core SDGs sectors. Second, IDB is focusing on building Industry 4.0 capacity in 5 industries, which our research shows these industries have most significant potential to transform the economies of the ISDB member countries by creating diversified exports and creating economic value add, and hence have a sustainable growth. So here we will be tackling during this webinar two out of the 5 strategic industries of the IDB. The 10 million, actually the youthful population of the IDB member countries would potentially provide a pool of 10 million job seekers and entrepreneurs annually, with the talent, energy, and adaptability required to drive sustainable socio-economic development at the time of structural change and transformation into an SDG era and beyond. So its new intervention framework helps member countries to leverage this opportunity to integrate with the global value chain for the future. Here, let me display some of the figures as per the IDB report published this year. The report called Inclusive Growth, Making Value Chain Work for Smallholder Farmers. The role of agriculture in feeding humankind has evolved into a diverse global sector whose operations range from farming to secondary processing and from small subsistence holding to large multinationals. It also plays a key role in achieving several of the SDGs, from the fight against poverty and hunger to the demand of decent work and economic growth. But also in the case of dairy farming, for example, it will boost gender diversity and equality. So agriculture is a major factor in the overall economy, employment, investment, and environment. The good news is that 57 of the ISDB member countries collectively have significant potential to utilize agriculture to drive their economies and to do so in ways that are truly inclusive. Together, member countries account for 29% of the world's total agriculture area and from 14 to 15% of the world's production. They also employ over 37% of the population of the 57 countries. Many indeed have a comparative advantage in the production and the commercialization of important global food crops. This includes rice, for which several member countries in Africa have favorable agroecologies even. The potential for the value chain to unleash the comparative advantage of member countries in various agricultural commodities is enormous. The agriculture is the main source of income for most of the rural poor in developing countries, and certainly many among the 57 ISDB member countries. It also plays a significant role in their economies as a whole. For instance, the average contribution of the sector to the GDP for all member countries in 2015 exceeded 17.7%. And reached over 27% among 18 member countries considered according to the United Nations LIFDCs, which means low income and food deficit countries. So these LIFDCs, among them, 40 to 80% of the population are employed by the agriculture sector, and more in rural areas where the incidence of poverty is highest. Moreover, in 2018, agriculture contributed in an impressive $650 billion to the GDP of the total of 57 member countries. In some regions, smaller economy accounted for as much as 57% of the GDP. I'm talking about Guinea-Bissau, and up to 71% of the total employment, the case of Djibouti, though both figures are lower for other countries with diversified economies such as Turkey. In total, IDB member countries currently account for almost a quarter of the world population and 9% of its GDP and 21% of the global value add in agriculture. Here, in a nutshell, the agricultural value chain, actually the value chain adopted by IDB, and in this slide, I will go through it quickly just to show how is the framework from production to market. An example here of the GVC in cocoa, where the global value chain goes from different stages, from farming to product extraction, primary processing, secondary processing, manufacturing, until it reaches the customer. Brother Hassan, here the need for financing through the value chain in the slide, the different needs is in different phases of the value chain, and Brother Hassan will talk about some of them in his presentation shortly. The same thing here. I'm going through some of the instruments. Brother Omar, Mustafa, Ansari spoke about Salam and other products. So here, some instruments that can be utilized for working capital. I can cite Salam, Murabaha, Musawama, Muzara'a, restricted Mudaraba, and of course other risk-sharing modes. For term financing instruments, I can cite Ijara, Service Ijara, Istisna, Diminishing Musharaka as well. Before I give the floor to my colleague Hassan, let me go through two slides. The first one, the trends, and the second one is the challenges of the agriculture industry. So the industry, the global population growth is about 8 million by 2030. It's heavily concentrated in the ISDB countries, which will significantly increase demand for food. For instance, the global population is projected to rise from 7.6 billion today to 8.6 billion in 2030 and 9.8 in 2050. So it's vital to further increase agriculture output in order to avoid the threat of food scarcity, especially in sub-Saharan Africa. The number of undernourished people have recently begun to age up again. In fact, current projections indicate that available calories must increase by about 1.5% per annum to curb world hunger by 2050. And perhaps the greatest challenge to do this is to do it sustainably. The second trend is the shift in consumer preferences and nutritional habits. In fact, rising incomes and urbanization is shifting consumer preferences and nutritional habits. For example, spurring demand for meat in emerging countries. At the same time, we do have in emerging countries, emerging consumer groups are turning to healthy, convenient, sustainably produced food and the substitute of meat. The third trend is innovation. In fact, unless decision action is taken on innovation and more sustainable farming techniques, climate change and resource depleting agriculture practices will hit IDB countries hard, limiting output and putting food security at risk. The last trend is the rural exodus. In fact, shrinking economic opportunities will continue to fuel a steady rural exodus in many ISDB countries to prevent lasting damages to their agricultural production potential. These academies need to investment and innovation in the agriculture sector to provide young workforces with jobs and skills. Finally, the challenges, I'm listing four. The first one is the structural weakness in food processing. In fact, ISDB countries are copious agricultural producers, but many show a structural weakness in food processing, causing them to miss out on the most lucrative segments of the agricultural value chains. To respond effectively to global calls post-COVID-19 for sustainability and quality standards, the region's agriculture needs to transform itself. Building a stronger food processing industry in ISDB member countries is the key to obtain higher global market shares and generate growth and employment. Second, at the same time, production and processing will need to become more resilient and resource efficient among the value chain. ISDB member countries need to take action now to create additional resources, increase their productivity, transform their business models in order to support stable growth and innovation. Third, agriculture output must increase even as food losses are avoided and consumption of fertilizers and water is reduced. International quality and food safety standards need to be applied in ISDB countries to cater the changing consumers' needs and keep local producers competitive in export markets. Finally, the creation of skilled jobs in the sector needs to be encouraged by mechanization, mechanization one, second, workforce education, and third, the improved infrastructure. To close, allow me to just to tell you that IDB will publish a report where it offers in-depth view on key trends and initiatives that will shape the future of the 57 ISDB member countries through 2030 and beyond. The publication is part of a series of rebuilding resilient value chain for the future for the key strategic 5 industries of the bank. Thank you so much, and over to you, Brother Hassan.
Okay.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Well, I think you can, okay. Thank you very much, Mr. Houssem, for your intervention. And also, I think it's now the time for Brother Syed HASSAN from Islamic Development Bank also, and for giving us his remarks, inshallah. Hello? It's like, wait, give me a minute.
I think, Brother Hassan, you are muted.
Yeah, let me activate it. Okay.
Okay, thank you very much, Brother Abbas. I was muted. Assalamu alaikum wa rahmatullahi wa barakatuh. A very good morning, afternoon, evening to wherever you may be. Thank you to Brother Abbas for inviting us and for IFN, and thank you to Dr. Houssem for that introduction in terms of giving the overall big picture of what IDB is doing in agriculture and how we are going to, how strategic we are approaching it. Now, I will be looking at more of the, let me share my screen. I will look at more of the small picture of how to do projects from a project level. How does IDB intervene in Islamic finance? And I'll be answering these two main questions, right? What is the value of Islamic finance? What is the main value of Islamic finance? And how do you apply this value to agriculture? So this is what I will be covering, inshallah, in my presentation. And we'll be using real examples from the projects that IDB has financed. And I hope that this will benefit you in terms of understanding how this is practiced in reality. So we understand that Islamic finance mobilizes resources to the real sector, and it's channeled to the real sector rather than money markets. So the real difference is that the value addition, right? We have to demonstrate value addition. If there is no value addition, then essentially it's riba, right? So how do you demonstrate value addition? And one thing we also know is that one misconception, Islamic finance is not, or microfinance is not just for Muslims, it's for everybody. And how can you demonstrate? And here is an example of a photo that Akhwat is giving interest-free loans to recipients in the church. So they are Christians. And here is the same mega loan disbursement. It's not Friday prayers, it's an event in Badashai Mosque. This now probably COVID will be more difficult, but in that time they were doing the disbursement in large events like this in front of the masjid. So here you can see the value. Once you have value, regardless of the religion, whether you're Muslim, Christian, Hindu, you would want Islamic finance. And this is what we want to encourage and what we want to promote in IDB. Now, one thing that I would like to share a personal experience when about 3 years ago, I was given the opportunity to go to Kenya and by the Bill and Melinda Gates Foundation. And they brought me to a place that they said they sponsored a research facility, IBM Research in Kenya, to conduct a study on whether credit provided by Islamic financial institutions are more effective means in promoting poverty alleviation or MSME development. Excuse me. So the methodology of what they did was they did a desk research of Islamic banks in the region, and essentially this is their findings, right? More than 80% of the financing provided is Islamic banks through Murabaha. There's no substantial difference on how financing is conducted from the conventional, other than changes in legal documentation and terminology. So Islamic interest rates, they changed to profit rates and so on, but it's no real difference. So they concluded, and this was done in my presence, they say that Islamic finance is a sham. It's conventional finance clothed in a different form. So, and they asked, please, so react to, these are our findings. What do you think? What, if we are given in this, we are given such presentation, and this is not just done by researchers, even some Muslim researchers have come to such a finding, and you need to understand why they come up with such a finding based on the things that they see and the things that they analyze. And this is how we responded, and I hope that you, maybe you also, if you come across such questions, you can respond to in this manner. Islamic finance is measured on a spectrum. Now, Sharia compliance is at the minimum requirement, but it is not it does not fulfill the full potential of Islamic finance. Once you achieve Sharia compliance, which is what we tell people, you must be Sharia compliant, you must be Sharia compliant. You're only at level 0, and you have not really maximized the potential of Islamic finance. When you increase the value to the client, then you really maximize the performance of Islamic finance. So it's a minimum requirement, but not the gold standard. Among Islamic financial institutions, Islamic microfinance institutions have shown to be the most successful in tackling poverty alleviation by generating value to the poor, which is not possible under the conventional methodology. And even the Sharia compliant, if you look at Murabaha versus conventional, you can see the difference, even at the compliant level. One is that it has to only finance Sharia compliant activities, which means that it promotes social good. You cannot finance activities which are non-Sharia compliant, whether it be tobacco, whether it be liquor, wineries, and so on, because, and these are the activities that are commonly, can be common and will cause harm to the community and the farmers and the community around it. So it only promotes social good. Second is it's backed by tangible assets. It prevents diversion of funds. Why is this important? Now, we know that conventional microfinance has financed a lot of women. 90% of the financing for microfinance or microcredit is going to women. But so much of that money is not actually used by the woman. They are being abused. Either their husbands, their brothers, their uncles are the ones who actually use the money, but they borrow under the name of their woman relative because they have more likelihood to receive approval for the financing. And what happened is they get back, if the money is lost, the woman is the one who's stuck with paying the loan. And we have seen so many cases whereby women commit suicide in India, in Sri Lanka, and so on. So many microcredit crises, they call it, because women commit suicide on a large level because they are unable to pay because they are being abused. So preventing diversion of the funds, the loan has to be used for the purpose it is intended for. The third is maximum limit of debt liability. So if you look at Murabba, the selling price cannot change over time. The selling price is fixed. So if a woman is unable to, for whatever reason, they agree to extend the time to repay their loan, that selling price does not change. She will pay, if she owns $1,000 to be paid over 6 months and she needs another 6 months, she will pay $1,000 over 12 months. It does not go up. And once you do this, you're Sharia compliant, right? And you are at level 0. You're missing out. Yes, you are Sharia compliant. Muslims can take the loan, but you're missing out. How can we be Sharia performing? And this is the message that we tell our microfinance institutions, the ones that we support, that do not stop at Sharia compliance. You have to go and value add to your clients beyond being Sharia compliant. So, example, murabaha, right? We all heard murabaha is to buy on product on behalf of a client, and therefore it's a short-term financing. The MFI purchases seeds, fertilizers, and sells it to the farmer at a higher price, at a marked up price. Now, what we encourage is the MFI would negotiate with the supplier and fertilizer. So they don't just buy for one client. They buy for 10, 20, 100 clients. Why can't they negotiate with the supplier and say that, yes, the market price is $100, but no, I want to buy it at $70. Then pass off those savings to their clients. Won't they be more competitive? Won't they value add to their clients? This is a simple value chain: supplier, farmer, crop, and wholesaler. Now, if you look at Salam, it looks at the other side of the value chain. So here, Salam is to buy advance purchase, right? To pay in advance, and you get the crop, whether it be tomatoes, potatoes. After 6 months, when it's harvest time, you get the crops, and then the MFI will sell on its behalf. So when they sell, they should negotiate with the wholesaler, with the processor, with the buyer on the other side of the value chain. So this is where we encourage economic empowerment, where they value add and not just provide credit. They value add by negotiating, and they transfer this to the value to the clients. Let's look at a real example, and this we have done in many countries: Sudan, Albania, Palestine, Egypt, and Indonesia, and so on. Now, client Murabba, client is $1,000 to buy fertilizer and seeds. He expects to sell the crop to a buyer at $1,500. Microfinance institution negotiates with the supplier at the retailer for wholesale and gets 30% discount. So the negotiated purchase price is $700. They borrow the money from the MFI at 30% interest or profit rate. So for conventional, they will say interest. Sharia compliant, they will say profit rate. But same, use the same profit rate per annum over 1 year. So they pay $900, $910 selling price after 12 months, which is $700 principal, $210 profit. If delayed by 12 months, no additional profit is due. Penalty payments allowed, but must be given to charity. So let's compare. If it's a conventional microfinance institution, how much profit will the client make? $1,500 minus $1,300, which is $1,000 principal, $300 interest. So the client will make $200, right? The MFI will make $300 because it's 30% interest of $1,000. So that's clear. Now, a Sharia performing institution which negotiates on behalf of the client, $1,500 minus $910, which is the selling price of $700 principal and $210 profit. So he makes $590. MFI will still make 30% of the $700 principal, but which is slightly less, but he will still make 30% of profit rate of the loan that he provides. So can we measure impact? We can easily measure impact. So here you can see how much will a client earn if the MFI value adds in that transaction. He will earn $390 more. And this is something that Islamic economic empowerment institutions can do, but conventional microfinance institution will never be able to measure this impact. And this is the beauty. The other side of the value chain, Salam, client needs $1,000 to buy, and this we do in Sudan, Palestine, and other different countries. Client needs $1,000 to buy raw materials to sell $1,500 of maftul. This particular example is from Palestine. Maftul is a special couscous in Palestine. The target profit rate is 30%. It contracts Maftul for $1,154. The MFI negotiates with the buyer for 30% higher price on the buyer side. So selling at $1,950. MFI receives the Maftul from client and sells it at $1,950. Returns 50% of the additional profit of $450. So the benefit he shares, he takes 50% and returns 50% of the additional profits to the client. So here you can see that again for conventional microfinance at 30% interest rate, it will be 1,005 divided minus 1,003 is $200. MFI earns $300 interest, so client earns 200, MFI earns $300 interest. With salam in negotiation, it will be 1,154 minus $1,000, and you add the profit sharing to $225, you get $379. You compare that with a microfinance, 1,950 minus 1,154 minus 225, they will earn $571 for taking that market risk. So you can see here, the client earns more, the MFI earns more. So you get win-win situation because you are actually value adding, you are negotiating with the client, with the buyer to get a better margin for the Maftul that is being sold. So again, can we measure impact? What the MFI has done and how the MFI has helped the client to earn more income, more profit? We can easily measure impact. And here we also have done it in a form of, those are some from transactional level type of interventions. We have also done value chain structured models. Here you have a Wat Balal cattle fattening project, whereby a produce of 7,000 cattle annually meeting export standards. This is the idea. A group of Sudanese businessmen who had markets were working in the GCC, but they wanted to find a way to help the people in Sudan to export to the GCC. So they approached Bank of Khartoum Irada to create a program to fatten cattle, finance it, and sell it to the GCC. So the bank invested 95% of Wat Balal, and the remaining 5% invested by the Sudanese businessmen. The money investment is used to finance Murabah. Murabah is also used to buy the purchase cost of the calves. The investment is used to fatten it and to sell it. So they created a Wat Balal company, which is like a company owned by the community. You can consider it to be like a Waqf kind of structure, whereby the company is not owned by individuals but owned by the community. It is then there's a profit sharing arrangement and it's a diminishing musharaka arrangement. So the bank will reduce its share from 95% to 0, and the community would increase the share from 5% to 100%. And the profits is used to 40% is used to purchase calves, 40% is used to do community programs for the poor, medical, schools, and so on, and 20% is used to manage company. So this is how they manage the company. They're able to develop a sustainable company to fatten cows for the benefit of community in a Sharia compliant in a manner that will benefit the community business and by helping them to sell to the GCC. Another example, cattle fattening again under Adel Khair project in Egypt. Same cattle fattening but different model. This is an incubation model. So here we had a company called Adel Khair, which is an NGO. And Adel Khair, what they've been doing is they create farms. And they have been hiring people, poor people, to manage the farms. And they sell, so they create jobs, which is good. But then we came up with the idea, why don't you create an incubator system? So they created a pilot incubator farm, but instead of hiring permanent workers, they got the female young woman to join the incubator for 9 months. Now, during these 9 months, the woman would receive a loan of about $30,000 to purchase cattle for fattening. They would then be taught how to fatten the cattle. They would receive an allowance over the period of the 9 months. Adilkhair would provide them the capacity building, would train them, would ensure that the cattle receive the proper care to mitigate all the risks relating to cattle fattening, and they would also help to sell the cattle. So when they sell the cattle, they deduct all the costs involved, and towards when they graduate, when the woman graduate, they would receive when the woman graduate, they would receive a certificate that they have graduated from the incubator, as well as their share of profits from the sale of the cattle that they looked after. After they graduate from the incubator, they would buy 1 or 2 cows in their own home to carry on their project, to carry on their small business. So why is value chain analysis important? It's a key to Shariah performance. How do you value add if you don't know the market? You don't know the sector. You must know the sector. And this is done through value chain analysis. So you determine who earns what and find ways to value add. Shariah performing microfinance institutions or economic empowerment MFIs able to help poor clients by helping them save money and earn money, contributing to poverty elevation. And they are more competitive and more sustainable. If you were to choose between conventional and some of the examples I showed you to get a loan, which one would you choose? Definitely the MFIs, the Shariah performing Islamic MFIs. And unlike conventional microfinance, we can easily measure the impact of financing, and that is done by the Shariah performing MFIs. It's a proven methodology for MSME growth. Now, who says that you can just provide credit to someone who's poor and they will be able to come out of poverty? MSME both goes beyond just giving credit. They need also access to markets, access to management, access to know-how. This is all key ingredients. And by doing this type of intervention, by value adding, this is what Islamic finance is doing to the poor. And there are many different terminologies. ADB calls it finance plus, SME development sector calls it smart money. IDB, we call it economic empowerment. And in Malaysia now, they are doing this, they're spinning this terminology called value-based intermediation. But essentially, this is all means the same thing. All acknowledge that, look, you cannot just provide credit. We have to provide credit as well as access to markets, management, know-how, fair prices, and so on. You must value add. And this is how to do value chain analysis. I won't go through, but we have a proper methodology and proper toolkit in helping the microfinance institution set the boundaries, identify the activities, value chain, know who's the stakeholders involved, how to interact, what is the prices involved, identify the issues and the business opportunities. Now, I give you a simple example, right? How simple it can be done. And this is done by right on the ground, the credit officer. How did they do this? A credit officer, a loan officer meets a traditional rice farmer who is interested in getting a loan. The farmer had 3 hectares of land, which he grows rice. He estimates the land yield an average of 4 tons per hectare. Due to traditional practices, it estimated it costs $359 per hectare. He sells it at $481 to a middleman. Transportation costs $20 per hectare. Purchases the price at $669 per hectare. Farmers produce 2 crop cycles a year. Can you verify the data? Can you collect the data? Is it easy? If you are a loan officer who visits agricultural clients every time, you see with very little amount of training, you see the land, you can know how many tons, how many acres of land or hectares of land. You see how the farmer is doing practices. You can tell what is the fertilizer, cost of fertilizer, how many tons he's using it, whether his methods are going to yield benefits or not. And you can easily do what we call a napkin business plan. you know, this is actual terminology. You can do on a piece of tissue paper, how much you think the farmer will earn. And then you go, you also know, if you have a bit of non-market knowledge, you know how much. You go to the middle, you go to the market, the village market, how much will it be sold for? Middleman is earning how much? What's the price there? How much will it cost to transport? It is a simple, you won't get like pinpoint exact details, but good enough. You can determine how much the rice farmer will likely earn, and what will be the how much the middleman will earn. Farmer earnings in one crop cycle, earning per day. Can you calculate all this? How much does the middleman earn? What is the business opportunities? All this can be easily calculated on a piece of tissue paper or napkin. So here, I won't go through the calculation, but you can easily, using the simple data that's given here, you can calculate how much the farmer is earning, how much the middleman is earning, and what can you do to bypass and to value add. So maybe in this case, provide salam to bypass the middleman, because you can see the middleman earns $2,000, which is so much money compared to the farmer. So why don't we take the share of the middleman's profit and put it to the farmer so that he earns more money? In this way, we value add to the client. So these are the ways that you do value chain in a simple level. Even at the loan officer, you can do it. Just now I showed you some of the more complex where you do project analysis, but even at the loan officer, he can do a simple analysis, value chain analysis, to determine how to actually provide a good product, financial product, Islamic financial product that will value add to the client. So thank you so much. I hope I have been able to explain how Islamic finance value adds and how this value add is applicable and applied to agriculture. Thank you. Assalamu alaikum. I'll now hand over to Brother Abbas.
Brother Abbas, you are muted.
Yes, assalamu alaikum. Okay, thank you very much, Brother Syed Hassan, for sharing this practical aspect of Islamic finance, Islamic Development Bank activities on the ground of agriculture. I think actually we have completed with the presentation. We'll move to the contribution and other eventually questions. Oh, sorry, I forgot. We have one last panelist, who is Said Ben Afane Ibouroi from ITFC, Regional East and West Africa, and based in Dakar. And he is working with ICD, another member of ISDB group. Mr. Afane. Okay, I think okay. I think it's okay for you. You can actually start your presentation. Sorry for the mistake.
Okay. Assalamu alaikum, everybody, and thank you for this opportunity to be here and share with all of us. So as Brother Abbas was saying, my name is Said Ben Afane. I'm the regional head for Western of the Islamic Development Bank Group. If you allow me, I would like to share my screen and show my presentation. Brother Abbas, you are the master.
Yeah, you can go on. Okay. Yeah.
So here it is.
Okay, I'm actually seeing it.
Is it?
Yeah. You are seeing it, eh? You can. Yeah, hello.
Trying to...
Okay, you can.
Okay. Yes, sir. So I'm going to, in terms of financing agriculture in sub-Saharan Africa, and try to see what we can learn from that, and maybe also we can get some ideas with all participants on how to use ITFC experience and build on it for the well-being of African people. So, sorry, it's very slow. So as you know, ITFC is a member of the Islamic Development Bank Group, which was created in 1975 with a total of 6 entities. You have the mother company, the Islamic Development Bank, which works mainly on infrastructure projects. Then you have IRTI, our training and research institute, ISEC, which is specialized in guarantee and insurance of export and investment. Then you have ICD, which is specialized in private sector of the group, and ISFD, which is specialized in more humanitarian, I would say, facilities. So our ITFC was rated A1 by Moody's, billion US dollar to member countries. Our vision is to be the leading provider of trade solution for OIC member countries' needs, with the mission being a catalyst for trade development among OIC member countries and beyond. So we operate in the 57 member countries of OIC. As you can see, those countries are located all over the different continents. As I said, in 2008, we started with a total approval of 2.5 billion US dollar, and this has reached, as of end of 2019, 5.8 billion US dollar, with a total of 784 operations. Now, when we regard the trade approvals by region, you can see that Africa in 2008 was quite small, less than 230 million US dollar. But alhamdulillah, last year we reached 2 billion US dollar. Now, in terms of sector, we've been very active in the energy sector, supporting our member countries which are not the necessary petroleum products for the production of energy. The number 2 sector where we are very active, as you can see, is food and agriculture, which is the first employer in our member countries, and of course, very important in terms of food security. With regards to the total approval for agriculture on all member countries, we have 6.2 billion US dollars. Now, for Africa, the figure is more than 1.2 billion US dollar. And you can see that the share also of agriculture for Africa is very high compared to our global figure, because globally it's 12% of our financing that goes to agriculture. But when it comes to Africa, given the central role of agriculture, this is the number 1 indeed sector where we are active in Africa, 59% of our financing. So beside financing, we understood that providing cash is not enough. And if we want our member countries to develop, we need also to enhance the capacity of our member countries. Capacity meaning the regulation, meaning the human capital, make more than 90% of the companies, so of the private sector. So SMEs are very important of Africa, and even in the agriculture sector, we want to support the development of SMEs through financing for local banks to be then shared with the SMEs, but also in terms of capacity building to train SMEs, help them formalize their business plan, prepare the credit application, train them in strategic areas like accounting or leadership. Other capacity building programs that we have is the Cotton Trade Development Program. We have also Ibouroi platform. We are working with our partner Bolero to develop a platform that help indeed digitize shipping documents, meaning that instead of sending shipping documents, you know, invoices, certificate of origin through DHL and other courier services, to make it directly in line and at the same time have it safe and legally binding. We have another program with OCP, the Moroccan company specialized in fertilizer, to go in the countryside and make soil analysis, and at the same time also share best practices with farmers. So I wanted to share two examples of what we've been doing in sub-Saharan Africa. The number one case study is Sofitex. You know, in Burkina, they used to call ITFC the Cotton Bank of Africa. We've been very active in the cotton sector since 2006, even before creation of ITFC. While we were at that time a department of IDB, we were already active in what they call the white gold. So to date, we have provided 10 operations in favor of the cotton sector of Burkina, out of a total of 1.6 billion financing in the whole West Africa, especially in Cameroon and Benin. If we took the example of the last 2020 financing, which was for 100 million euro, we estimate that 150,000 cotton producers have benefited from the financing for the production of more than 245,000 metric ton of cotton. So this is only one operation. Cotton financing is very important. For the country, it's a vehicle to attract foreign currencies that will then help the country to import goods. Because as you know, they cannot import with the local currency CFA. They need to use international currencies like euro or US dollar. So this is a mean indeed when they export their cotton to bring foreign currencies into the country. It is also, of course, very important to enhance farmers' income and even to boost the production of the country, because since farmers know that ITFC will be there to purchase the cotton that will be produced, this will indeed encourage cotton producers to produce more and work on a bigger area of cotton production. For this deal, for this West African cotton program, we have won different awards internationally. The latest one was the IFIM Deal of the Year in 2017. So here, maybe no need to go into detail since AAOIFI has explained how the Murabaha work. So basically, ITFC signed a Murabaha agreement with the government of Burkina and Sofitex. Then Sofitex will go and sign supply contract with farmers and cooperatives. At the end, ITFC will pay the farmers and the cooperatives for the cotton, the raw cotton delivered to Sofitex. Once that Sofitex gets the raw cotton, they will gin it, meaning that they will produce cotton fiber that will be then sold on the international market, especially to textile factories in Asia that will produce clothes. And with the revenues from the sale of the fiber, this will indeed allow the settlement of ITFC financing. So here you have some pictures of the team in Bobo Dioulasso in the south of Burkina Faso. And you have also some pictures of here. The second picture on the middle is in Indonesia, indeed, in the textile plant where they received the cotton from West Africa. So one other very important program, agricultural program we have is ITFC West Africa Groundnut Program. Indeed, in our intervention, as you see, we target very strategic commodities. We have talked about cotton. We are also very active in the groundnuts, whether in Senegal or in the Gambia. So with regards to Gambia, we have approved since 2008 10 operations for a total of $178 million. Cotton groundnut story is very important as it represents for the country 60% of the earnings from agricultural exports. Here also, what makes this deal very important is the application of our new strategy of not going only with a financing, but for each operation, try to put a capacity building program. That's what we call in ITFC an integrated trade solution. So we have a financing to allow the national company to purchase the production of groundnuts from farmers, but at the same time, we put in place a capacity building here, the aflatoxin mitigation program, which aims at eradicating aflatoxin, which is a fungus that is found in the groundnuts and indeed can be dangerous for the health and from the economic perspective, it prevents Gambia, it has prevented in the past Gambia from exporting its national production of groundnuts into markets such as the European Union or even the US, where the criteria for the import of groundnuts are very strict. So since the intervention of ITFC program with regards to aflatoxin mitigation, we've been able to reduce the rate of aflatoxin in Gambian groundnuts, and then also this allowed the country to access new markets and also sell at a higher price, 30% on average when they sell the groundnuts to Europe compared to if they were selling to Asia, especially China. So 30% is very high, especially if this increase in the export price is replicated at the farmer level. So when we look at the last operation, which was for $30 million US, we estimate that about 150,000 farmers have been impacted by this operation, and the target was to collect from those farmers 80,000 metric tons. So here we have a graph that shows how our financing works. So ITFC signs a Murabaha agreement with the government of the Gambia. Then ITFC ITFC also signed a Wakala agreement, an agency agreement with NFS PMC, which is the national groundnut company, where we appoint the agent to purchase groundnuts on behalf of ITFC. So the agent will purchase the goods on behalf of ITFC, take delivery of the goods, and then it will store the goods in a warehouse, and then the Wakala is terminated, and the government will appoint an executing agency to whom the groundnuts will be released for shipment to international off-takers. So here you have some pictures of groundnut production in the Gambia. So some lessons learned, maybe ways forward for agriculture. Why ITFC is so involved in agriculture? As I said, in a nutshell, because agriculture fosters food security, and food is, as you know, the basic human need of everybody. So unfortunately, in many of our member countries, till today in 2020, we have food security issues. So we have to be there and support our member countries. Agriculture also is the first employer, not only in Africa, but I think if you look at the global level, most people today work in that area, making agriculture very important. As I said, agriculture is a way for farmers to earn income, to make a living, pay schools, pay health expenses. For the country, it is a significant FX provider, foreign currency provider. And we realize at ITFC that the impact expected from our financing could not be reached, and that capacity building is essential, meaning that with the high targets in terms of development impact that we have, we shouldn't invest ourselves not only in financing, but also in capacity building. So where we come, the way forward for ITFC, as I said, is to provide to member countries integrated trade solutions where financing facilities are each time combined with capacity building programs. The way forward also is digitization. Meaning that new IT tools have to be provided to farmers to enhance their productivity. When we talk about IT tools, sometimes it can be easy and provided through application with their smartphones, for instance. We need freer markets, of course, and we welcome the African Continental Free Trade Agreement that should be implemented in 2020. I think this is very important for African farmers. And as my brothers from ISDB was saying, we need to have a value chain approach. Africa cannot just be an exporter of raw materials, but we need, of course, ITFC's financing, for instance, cotton production. This is not enough. We need to partner with other international institutions to help Burkina transform its fiber locally and produce the textile and the clothes that Burkina people are wearing every day. So this is very important. Same thing for the groundnuts. We are supporting the production of groundnuts, but we want the Gambian tomorrow to have their groundnut butter produced locally and not from the US. So as the Secretary General of IOFI was saying, Islamic finance is well equipped. We have a lot of tools that could support this. When we talk about value chains and industrialization, We have, of course, products like Ijara. We have Istisna, and something that is very important, and we are working on it internally, is Salam, so that we can, from the beginning, and even before the beginning of the agricultural season, being able to provide cash financing facilities to farmers. This is something very important, and we want to put that in place, inshallah, God willing, in 2020. Thank you very much. That's all for me.
Okay, thank you very much, Brother Said, for this brilliant presentation. I think we got a lot of information about Islamic finance agriculture here in Africa, from IDB, from IOFI, from all international financial institutions. So now, ladies and gentlemen, I think it's time now for us to move to the Q&A session. Allow me to take advantage of my position as moderator to maybe ask some questions. Okay, firstly, ask some questions. The first question is to Mr. Syed ALSAGOFF. I just want to know what is the, how can I say, the feedback was actually from the different programs, Islamic microfinance program in Africa. We have PNMP here in Ivory Coast. We also have Promise in Senegal. We have Ahmed some initiative in Chad, Promise Fit also. So many initiatives. So actually, I think after 5 years of activities, or more than 5 years, what are the feedback, the general feedback you have to share with us about all these initiatives in different countries?
Thank you, Brother Abbas. A very, very important question. In the challenge for IDB and for any multilateral donor, especially for IDB, is to get the financial intermediary to move out of its mindset of being a banker, of just providing credit. Now, this is a challenge, and we go step by step in doing this. We have to make them be able to provide them the capacity building for them to be able to know how to do this. Now, from day one, we don't start and say, okay, now you're going to do value chain sophisticated models like some of the cattle fattening examples I gave you from day one. No, we ask them to move from step by step. Yes, okay, fine. You want to do murabah? Can you do it in a value-added manner? Next, why only murabah? Why not try salam? Next, okay, now you know who are the stakeholders, who are the suppliers, who are the buyers. Can you do something more interesting, a more structured project financing approach? So it goes step by step. Some financial institutions may not be willing to go take the risk to go like do the financial type of models, but at the very least, they should be able to value add in every transaction that they do. So some countries do better than others. That's why we have a scale, and some countries going in that scale. Some countries are lower on that scale, some countries are higher on that scale. It takes time for them to know the market. The more they know the market, the more they can negotiate, the more that they can value add. Thank you.
Thank you very much, Brother Said, for this question, for this answer. Brother Said, do you want to add something? Hello? Oh, okay. Okay, so actually we have a lot of questions here in the Q&A questions. I will just try to select one question from a friend of mine from Ghana, Mr. Alaru Salifu. Salam alaikum, Mr. Salifu. Can you please ask your question? Yeah, you can go on.
privileged to be part of this presentation. It's actually an eye-opener to me, and I've taken a lot of notes. I'm sure with time we should be able to get back with the questions that we have. But I want to know the type of program IDB is running in Ghana, and whether there is a way we can get in touch with the authorities in Ghana. This is my question, please.
Okay, thank you very much. Before giving opportunity to Mr. Houssem to answer you, I think actually Ghana is not a member country of Islamic Development Bank yet. So this is what I know, according to what I know. But I will allow people, Mr. SYED or Mr. Houssem, to give you better answer, okay, about what they are doing in Ghana.
Okay, maybe I'll address that question. Like Brother Abbas mentioned, it's not a member country of IDB, so there's not that much that we can do. Nevertheless, there is an opportunity, technical assistance program where we do not just restrict to IDB member countries. We give priority to IDB member countries, but when we promote Islamic finance, it can go beyond IDB member countries. So if the government of Ghana submits a request to IDB for technical assistance to develop the Islamic finance sector, that may be considered by IDB. Yeah. Thank you.
Okay, thank you, Brother Hassan. Okay, I just want to also to ensure that actually we are opening a branch in Ghana of IFIM in Ghana actually, and I think just because of this this situation, this COVID situation, okay, that's why we actually suspended this procedure, but very soon we will do it, and we will be supporting the Central Bank of Ghana and all authorities of Ghana for maybe getting this opportunity to work with the Islamic Development Bank. Inshallah, I have also some other question from Brother Hamza. Okay, Brother Hamza. Assalamu alaikum. I will also, if I will, okay.
I don't know if you can voice his question, Brother Abbas.
I will do that. How, Brother Hamza is asking, how is ITB helping in the development of human capacity in knowledge of Islamic finance? He is from Nigeria as well.
I can take this one. Actually, IDB in the terms of Islamic finance and the capacity development in Islamic finance does have different activities all over the group. So I'm sure even Brother Saeed bin Afane, he can share about ITFC. But we do have the main institute or the main entity in charge of that is what we call IRTI, Institute of Research and Training, Islamic Research and Training Institute, to which I'm proud that I belonged to it a few years ago. And they do have a lot of trainings, they do have a lot of research, knowledge sharing, dissemination. By the way, yesterday they published research about the Islamic social finance in North Africa. A few years ago, they did it about East Africa and South Africa. I know that in the pipeline, they are planning to do it for West Africa. So in terms of activities, they are very active in knowledge dissemination and capacity development and in doing trainings. And this is the main entities. However, we do have a lot of departments. For instance, we do have a department called IFSD, in which they provide technical assistance and trainings to knowledge sharing to the member countries, and actually not only member countries, all over the globe. Thank you.
Okay, thank you very much, brother.
Maybe I'll just add a little. In Nigeria, you have a very good international Islamic finance institution in Kano. there's a institution in a university, agriculture university in Kano, and I have the privilege to actually give a seminar there, 2-day workshop there. And they had very good people who were very active in promoting Islamic finance. We are conducting some projects in Kano, and north of Kano, there's another district. I forget the name of the district. But yes, in that region, north of Nigeria, IDB has been quite active in developing the capacity and even having a few projects there. Thank you.
I confirm that we do have even the pipeline, other activities, knowledge sharing activities, and with the partnership with IBF and University of Bayero.
Okay, thank you very much. Okay, it's now time for Mr. Ahmed Ibrahim from Nigeria, for instance. He will share some experience in the field of agriculture in Nigeria. Mr. Ahmed. Yeah, Brother Ahmed. Okay. Please introduce and to
my name is Dr. Ibrahim Ahmad Mohammed from Nigeria, Federal University, Dusi. Are we together?
Yeah, we are together. Go on, you can go on.
MashaAllah. In Nigeria, actually, Murabaha is more accepted in terms of Islamic financing. Even though we have Salam and others, also they are practicing, but very few. But the most popular one is Murabaha financing. Since it's more similar or closer to the norms and values of the conventional financial institutions in terms of security and other things like that, unlike Salam. So in this, I conducted research where I tested some of the variables like farm credit, farmland, farm infrastructure toward agricultural financing. So when at the end of the research, we came across that the financing, there is relationship between agricultural financing and the agricultural output as well. So when I look at it from the conventional, all of them, they are significant in terms of supporting the agricultural
Okay, brother Ibrahim, it's like you are having an internet connection is not good. It's a little bit difficult for us to hear us.
I also to these variables. So, notwithstanding when this
okay, it's like okay.
So here we have Islamic banking, that is Islamic bank like Jaiz and Taj banks, who are the ones that are now operating in a full privilege and a full pledge. So the other aspect of the banks that are operating, that are the like Stanbic Bank, Keystone and others, they are operating on Windows. So in this aspect, so the Murabba is playing a vital role toward promoting agricultural production, more especially in our country, that is Nigeria, more especially Kano, which is the most populated state in Nigeria, where almost 90% or 95% of the activities that is as well. When we look at the other agribusiness also, agri-alliance also, they are dominating in this place. So Murabaha definitely is accepted and is playing a vital role, which is now accepted by the people here, more especially the farmers. So now the other aspect, the other variables, that's the products like Salam, they have also significant role that I conducted, but they are not like Murabaha, which is the highly accepted one now so far in Kano State, Nigeria.
Okay, thank you very much for for sharing this experience you have been in Nigeria.
Yeah.
We will be working very soon with you because we want to maybe plan another webinar to work and to talk very much or much more about the agriculture financing. I think the time for this webinar is ended. Okay, so I would like to share many thanks to all our panelists, especially Houssem Bedoui, especially Said Ben Afane, also especially from SYED ALSAGOFF, okay, from ISDB. Also, my special thanks to Brother Mustafa Omar Ansari for just giving us this very, very brilliant presentation. Assalamu alaikum wa rahmatullahi. Don't forget to follow us on the different social networks. We also are expecting collaboration with all your institutions for promoting this initiative of IFIM magazine, which will be in French, in English, and in Arabic, to allow all the global aspect, all the world to access the information from our industry in West Africa, for instance. Assalamu alaikum wa rahmatullahi wa barakatuh, and goodbye, and see you for the next session, inshallah.
Thank you very much.
Thank you. Assalamu alaikum.
Salam.